Welcome to the Meb Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
What went wrong for biotech? Like, what caused this kind of collapse in valuations and total investor flight? I mean, why is biotech trading like coal companies?
There are multiple variables at play. I'd say interest rates is the top of the list. And biotech, I think, as you dig into it, you realize is a sector that's probably more sensitive to cost of capital than almost any other sector. And that really is because these companies are they're more like options, in the sense that by design, they lose money for 8 to 10 to 12 years, and then they either generate a huge bolus of cash flows or they don't. And so when rates move up or down, you're discounting cash flows that are 10 or 12 years into the future. And so they're incredibly sensitive to rates. So I think the first sort of shot was that rates went up. That was incredibly damaging. And then the second thing that happened was, I think the relative opportunity set for public investors shifted, particularly as AI kind of came into the picture. And so a lot of the generalist hedge funds and the big mutual funds, so we're thinking Fidelity, T. Rowe, Janus Henderson, they all basically en masse rotated out of the sector. And there are some very successful, decently sized biotech hedge funds, but they can't on their own carry IPOs. And so when the generalists rotated out of biotech, and they've basically remained out of biotech, the public biotech specialist hedge funds were left in a situation where they could not unilaterally support IPOs. And what happened from there was that nothing could go public. And therefore, all of the late stage private investors had to devote all their capital to keeping late stage private companies solvent that they had been planning to offload onto the public folks. And that has backed up all the way to folks like us, whose business is basically to manufacture companies for those later stage private investors to focus on, and then ultimately to pass on to the public. So I think of it like a conveyor belt, and basically the conveyor belt has been shut down for 3 years.
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.